Assalamualaikum and a very good day to our beloved lecturer, Dr. Linda. We are from Group 9 and today we are going to present about our group project. I'm going to introduce our group member. For first one is Muhammad Haikal bin Saliman. Second one, Muhammad Nur Azmizi bin Razak. Third one is Muhammad Azuddin bin Muhammad Saimi. And the last one, myself, Ashraf bin Nurisham. So we proceed to introduction. Hi, my name is Ashraf bin Risham and I will do the introduction. Firstly, equity financing is the process of raising capital through the sale of shares. Basically, by selling shares, a business effectively sells ownership in its company in return for cash. Other than that, equity financing also comes from a variety of sources. For example, an entrepreneurship, family member, friends, and also professional investor. So next one is how equity financing works. First one, there will be a numerous round of equity investment for a startup that develops into a profitable business. Second one is, for example, an angel investor and venture capitalist is basically generally the first investor in a startup for a company.
Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad Haikal. So I will tell about content 1, advantage and disadvantage. So first of all, equity financing involves selling a portion of a company equity in return for capital. So the main advantage of equity financing is there is no obligation to repay the money accrue through it. Of course, the company owners want it to be successful and provide the equity investor with a good return on their investment, but without require payment or interest charge, as is the case with debt financing. So, in fact, the downside is quite large in order to gain funding. So, is come pro and cons. So, you will have to give the investor a percentage of your company. And you will have to share your profit and consult with a new partners at time you make a decision affecting to company. So what the advantage and what is disadvantage. So the advantage, first of all, less burden. So with equity financing, there is a no loan to repair. So the business does not have to make a monthly loan payment, which can be particularly important if the business does not initially generate a profit. And next, this is a turn give you the freedom to channel more money into your growing business. Secondly, credit issue gone. So if you don't have a credit worthiness, it can be said through poor credit, story of lack of financial track record. And also, equity can be better and more suitable than debt financing. And lastly, for advantage, learn and gain from partner. So with equity financing, you might form informal partnership with more knowledgeable or experienced individual. So some might be will connected, allowing your business to potentially benefit from their knowledge and their business network. So I will talk about the advantage. So first of all, the advantage is a share profit. When your investor will expect multiple return and deserve a share of your profit. However, this can be a worthwhile trade-off if you benefit from the value they bring as a financial backer and or their business acumen and experience. So next, loss of control. When the price to pay for equity financing and all of its potential advantage is that you need to share control of the company. And lastly, potential conflict. Sharing ownership and having to work with others could lead to some tension and conflict if there are different in vision, management style, and ways of returning in business. So it can be an issue to consider carefully. This for the extent deciding factor, So equity financing place no additional financial burden on the company. So I suggest if you follow the step, you can know what we can do. So firstly, if you creditworthiness is an issue, there could be a better option. Secondly, if you more of independent solo operator, you might be better off with a loan and not have to share decision making and control. That's all for this the advantage and disadvantage. Thank you.
Next, I will explain about the equity financing can contribute to the company sources. First one, numerous equity investment round for a startup developed into a profitable business. Next, secondary equity financing option like right issues or any issuance of stock unit with warrants as a bonus. Selling ownership, and then lastly is selling shares to financing for major asset purchases. There are seven types of equity financing to expand businesses. First, IPO, initial public offering. When a business decides to go public, such as the New York Stock Exchange, it conducts an initial public offering in which sell its first share on the market, being converted into a publicly traded corporation. The next one, SBIC, Small Business Investment Capital, a program that provides small firm with a venture capital financing is authorized and governed by the Small Business Administration. The next one, angel investor, those who provide funding exclusively for business. Mezzanine financing is a combination between equity and loan funding. A venture capital firm is organization that finance businesses in exchange for ownership or shares. Royalty financing, or we can call it as a revenue-based financing, is when investor provide fund for a business operating cost in exchange for a cut of a product sale. The next one is equity crowdfunding, which is that later involved in selling your firm share to the crowd. In this method, privately owned business owner can obtain capital by offering a percentage of their share to crowdfunded investor.
Assalamualaikum warahmatullahi wabarakatuh. Let's we continue our presentation, which is EF, which is equity financing. It involves the stock sale of the corporation, which is the investors will receive a piece of company's ownership in return for their money. For a smaller, privately held business, the procedure frequently will return agreement of some kind. The arrangement may be more complicated for bigger, publicly traded corporations, and for the long-term capital is regarded as equity capital. So in this case, the investors may sell their equity to other investors at any moment, and the company may view the equity as a long-term financing. Uh, Last but not least, the investor will tax on the role of the shareholder in the business and has an influence over how it is run. So next, how it will be calculated. So this is the one of the example, which is the scene is a company is currently valued at the 600,000 and the investor wants to invest 400,000 ringgit for a total company value for 1 million. So from this case, we can calculate it as the company owners will only control 60%, which is 600,000 ringgit, and the investor will gain 40% of the shares of the company that have sold. So next, this is the next example, which is the question is a company generates 1 million in product sales and wants to grow even more. So the investor wants to create a royalty financing agreement where it will provide a company with 50,000 for 6% of its revenue each year. So from this case, we can get the answer, which is if the 1 million ringgit generated, so the investor will only receive 60,000 each year. But if the sales is grew to 2 million ringgit annually, so the investor will receive 120,000 annually too.
Hi, so I'm going to continue for the conclusion. Uh, Equity financing is a mode of financing for the company where it takes funds from the investor through the sale of shares. And the second one is the primary obstacle that private equity will confront in the near future is providing its limited partners with improved volatility management. Uh, and also the fact that there is no specific indication providing a clear reading of this aggressive risk management strategy. So that's all from us. Thank you.